Hi guys, in this video I'm going to cover the Consumer Confidence Index as well as the Michigan Survey of Consumer Sentiment. These are the two major surveys that give us a sense of how households feel about their present conditions and their future conditions in terms of employment, income, and overall general business conditions. We'll start with the confidence survey or index. This comes out monthly from the Consumer Confidence Board. This board is a private organization, so if you want the full array of details, you're going to have to pay them. But we don't need all that detail. Our focus is going to be strictly on the narrative at the site's homepage. What they do is they contact 5,000 households every month, and they ask them 5 simple questions. Now, every month they're randomly pulling households, so they're getting different households every period. This is going to be different than the way the Michigan survey does it, where they actually pull from the same household every month, making the Michigan survey a little less erratic than the Conference Board survey. Let's take a look at the questions first. I've typed them in here, but they're also in your book. So the first question they ask is, how would you rate the present general business conditions in your area? Good, normal, or bad? This question is about present conditions. So that's about the current environment. The second question is, 6 months from now, do you think they will be better, the same, or worse? So notice this is about future conditions. The third question, what would you say about available jobs in your area right now? Plenty, not so many, or hard to get? This is about present conditions. Then 4 says, 6 months from now, do you think there will be more jobs, the same, or fewer jobs? So this one is about the future. And then what would you guess your family income to be 6 months from now? Higher, same, or lower? This is about the future. What I want you to notice is that 1, 2, 3 of the 5 questions are about future expectations, whereas 1, 2 of the 4 or 5 questions are about present conditions. That means that when they create this index, 60% of the index, right, 3 out of 5, is a future expectations index, and 40%, 2 out of 5 questions, is a present situation index. That'll help us understand the narrative a little better. So let's read through briefly a little bit of this. It says, the Conference Board Consumer Confidence Index improved slightly in February, following an increase in January. The index now stands at 130.7. The base period is 1985. So all that means is we have more confidence now than what we did in 1985, up from 130.4 in January. So if we were at 130.4 in January and now we're at 130.7, confidence has improved between January and February. The present situation index, based on consumers' assessment of current business and labor market conditions, decreased from 173.9 to 165.1. So the present situation index would be based on those 2 questions that we looked at, right? Question 1 and question 3. So as far as the present situation, there's been a decrease from January to February. However, the expectations index, based on consumers' short-term outlook for income, business, and the labor market conditions, increased from 101.4 last month to 107.8. That would be based on the other questions. So question 2, question 4, and then question 5. Consumer confidence improved slightly in February, following an increase in January, said the Senior Director of Economic Indicators. Despite the decline in the present situation index, consumers continue to view current conditions quite favorably. Consumers' short-term expectations improved, and when coupled with solid employment growth, should be enough to continue to support spending and economic growth in the near term. The Consumer Confidence Index is really important for our economy because we have an economy that is driven by consumers. Over 70% of gross domestic product is purchased every year by households. So if there's any diminishing of their confidence, that can affect spending in the economy, which of course spills over into decreased business activity, layoffs, and so on and so forth. So there's a lot more emphasis in an economy like ours that is consumer driven on this kind of confidence index. If we lived in an economy that did not have such a high proportion of GDP being bought by consumers, then we might not worry as much about consumer confidence. I mean, some economies are investment heavy. In other words, most of the spending comes from firms. China's kind of like this, where a good portion of their GDP is bought by businesses in the form of, equipment and structures and things like that, technology. So we would be more concerned in China about the business confidence index, not so much the consumer. The confidence index changes over time, and this website here assembles a chart to kind of show this change. I've got it set to max here, and you'll notice going all the way back to 1977, you get fluctuations, and a lot of these large fluctuations correlate strongly with the business cycle. For example, if we go back to 2000, we had a major collapse in the stock market, the NASDAQ bubble bust, or known as the dot-com bubble. And then we had, in 2001, we had 9/11. So those things brought the economy down and brought consumer confidence down with it. And then here you've got the Great Recession. By December 2007, we were at around 115 confidence, and you'll notice it just collapses all the way down to almost 20 because of that decreased economic. All right, let's take a look at the next report. This is going to be the survey of consumer sentiment. Comes out from the University of Michigan twice a month. And this survey is going to attempt to accomplish something similar to the Consumer Confidence Index from the Conference Board. They're going to survey households to get a sense of how they feel about their present situation and their future situation in terms of employment, income, and things like that. This is the data for the final results of March 2020. You'll notice it is an index, so just like the Consumer Confidence Index, we're relative to a base period. The base period is 1966. Again, the actual base period doesn't really matter because we're normally comparing one index number to another index number. For example, if you look at February 2020, we were at 101 in the index for the overall consumer sentiment. And then now it's at 89.1. That is a significant month-to-month drop, 11%, and year-over-year change, 9.5%. That'd be going back to this number here from 98.4 to 89.1. And then it breaks down the overall index into two subcategories. You've got the current economic conditions, analogous to the present situation index in the Consumer Confidence Survey, and then you've got the index of consumer expectations. This would be analogous to the expectations index for the Consumer Confidence Survey. Note that both of these dropped. So from February, we went from 114 to 103 in the current economic conditions. That's down 9.7%. And then in the expectations index, we went from 92 to 79. That's down 13.5%. No surprise here. There's been a lot of change in our economy in the past month. We've seen not only stock market collapses, but we've also seen the corona pandemic. So consumers are revealing their perception of this, their sentiment through these decreased figures. If we look at the changes across time, a good site to do this is Trading Economics. They have data that's updated pretty expeditiously. You'll notice that we've got the 89.1 here as the most recent March index, and look at that drop from 101. So this is the overall index, but you can compare this number here to the past several months. We were actually growing consumer confidence since last year, We can go back further. This is 1 year. If we go back 5 years, it fluctuates, but it certainly hasn't been this low until, unless we go back to probably 2016 or 2017. The survey itself is just a series of questions. There's 5 core questions that they use. Let me pull these up here. We'll go through these. It says, are you and your family living with you better off or worse off financially than you were a year ago? So this would be a present kind of situation question. Next one says, do you think that a year from now, you and your family living there will be better off financially, worse, or just about the same? So it says a year from now, so this would be a future expectations kind of question. 3, do you think that during the next 12 months we'll have good times financially, bad times, or otherwise? Well, next 12 months, so this would be a future type question, an expectations question. 4, looking ahead, what is more likely, that the country as a whole will have continued good times during the next 5 years or so, or that we will have periods of unemployment and depression? Again, a future kind of expectations question. And then finally, 5, about the big things people buy for their homes, such as furniture, a refrigerator, stove, television, things like that. Generally speaking, do you think now is a good time or a bad time to buy a major appliance? Well, we're talking about now, right? And so this would be a present index. So what I want you to see is that similar to the Consumer Confidence Index put out by the Conference Board, you have 2 of the 5 questions that are present oriented, current situation, whereas you have 3 of the 5 questions that are future expectations type questions. That's important because, again, we get this composite index. The 89.1 refers to the overall index, but it's broken down into the current economic conditions index, which is about 40% of all the questions, and then the index of consumer expectations, which is about 60% of the index. So economists tend to prefer this survey over the survey put out by the Conference Board for a couple of reasons. One, it has a strong correlation with future consumer spending, about 70% correlation, which means this particular survey is a leading economic indicator of future activity. We like leading indicators because they tell us what's going to happen in the future. The second reason is that this report focuses its questions more on the financial and income aspects of the household rather than on the employment, kind of labor market aspects of the household. That gives the consumer survey a little bit more predictive power because people's spending in the immediate future is going to be more directly connected to what happens to the household finances than it does to what happens to employment. Employment doesn't change dramatically over short periods of time, whereas financial values can. Your income can change quite a bit if you lose hours, for example, at work, or your wealth can drop significantly if the stock market collapses, things like that. So the survey of consumer sentiment is a good place to get information about what's to come in consumer spending. The last thing I want to show you here is under the link tables. If you scroll down to expected changes in inflation rates, click on that. When they do the questions, one of the things they ask is what people expect inflation to be in the future. So if you ever need an indicator to assess how people feel about future prices, this is it. And it goes back a year. So for example, in March 2020, the survey suggested that people expect next year's inflation to be about 2.2%, and they expect inflation over the next 5 years to be 2.3% per year. Okay, guys, that's it for this. If you have any questions, feel free to let me know. Thanks.